Hello, in this lesson we will learn what commodities and futures contracts are and how gold is viewed as a tradable commodity in the futures contracts market. Do you think gold prices will go up further? Are you sure that crude oil prices are going to fall? Have you heard that the soya crop this year is bad and will result in soya prices going up? If you believe that these predictions have a good chance of coming true and are willing to bet some money on them, you could try your hand at playing the commodity futures market. In today's market, commodities and raw materials are traded, including metals such as gold, silver and iron, and agricultural products such as corn, coffee, rice and wheat. A futures contract is an agreement between two parties to buy or sell a specified asset in the future for a price agreed upon today. Futures contracts help mitigate the risk of wild price fluctuations of the asset. The party agreeing to buy the underlying asset in the future is said to be long, and the party agreeing to sell the asset in the future is said to be short. In every futures contract, everything is specified: the quantity and quality of the asset, the specific price per unit, and the date and method of delivery. The price of a futures contract is represented by the agreed-upon price of the underlying commodity or financial instrument that will be delivered in the future. But although the futures contract has an expiration date, you don't have to hold the contract until it expires. You can cancel it anytime you like. Participating in the futures market does not necessarily mean that you'll be responsible for receiving or delivering large inventories of physical commodities. Remember, buyers and sellers in the futures market primarily enter into futures contracts to hedge risk or speculate rather than to exchange physical goods. That is why futures are used as financial instruments by not only producers and consumers, but also speculators. Before futures trading came about, any producer of a commodity, for example, a farmer growing wheat or corn, found himself at the mercy of a dealer when it came to selling his product. The system needed to be legalised in order that a specified amount and quality of product could be traded between producers and dealers at a specified date. Contracts were drawn up between the two parties, specifying a certain amount and quality of a commodity that would be delivered in a particular month, and that's how futures trading began. A few decades ago, futures markets consisted of only a few farm products, but now they've been joined by a huge number of tradable commodities, such as metals like gold, silver and platinum, livestock like pork bellies and cattle, energies like crude oil and natural gas, foodstuffs like coffee and orange juice, and industrials like lumber and cotton. Modern futures markets include a wide range of interest rate instruments, currencies, stocks, and other indices such as the Dow Jones, Nasdaq, and S&P 500. What's interesting about buying or selling futures contracts is that you only pay for a percentage of the price of the contract. This is called buying on margin or leveraging. The difference with futures is that you're not buying any actual stock, so the initial margin payment is more of a good faith deposit to cover possible losses. If the market goes against the trader's position, he may lose some, all, or possibly more than the margin he's put up. But if the market goes with a trader's position, he makes a profit and he gets his margin back. Unlike the stock market, futures positions are settled on a daily basis, which means that gains and losses from a day's trading are deducted or credited to a person's account each day. In the stock market, the capital gains or losses from movements in price aren't realised until the investor decides to sell the stock or cover the short position. Trading futures contracts have several advantages over other investments. Futures are highly leveraged investments. Speculating with futures contracts is basically a paper investment without the need to hold the commodity. An investor can make money more quickly on a futures trade. Firstly, because he's trading with around 10 times as much of the commodity secured with his margin. And secondly, because futures markets tend to move more quickly than cash markets. Futures trading markets are usually fairer than other markets, like stocks and shares, because it is harder to get inside information. Most futures markets are very liquid. There are huge amounts of contracts traded every day. Commission charges are small compared to other investments and are paid after the position has ended. Here is a short overview about gold and why to consider trading this commodity. Gold is the oldest precious metal known to man. It is found widely throughout the geologic world, and since the early days, people have considered it as a precious metal for coinage, jewellery, and other arts. Gold has been used throughout history as money and has been a relative standard for currency equivalents specific to economic regions or countries until recent times. Many European countries implemented gold standards in the latter part of the 19th century, until these were temporarily suspended in the financial crisis involving World War I. After World War II, the Bretton Woods system pegged the United States dollar to gold at a rate of US dollars 35 per troy ounce. The system existed until the 1971 Nixon shock, when the US unilaterally suspended the direct convertibility of the United States dollar to gold and made the transition to a flat currency system. The last currency to be divorced from gold was the Swiss franc in 2000. Today, like most commodities, the price of gold is driven by supply and demand, including demand for speculation. However, unlike most other commodities, saving and disposal plays a larger role in affecting its price than its consumption. Most of the gold ever mined still exists in accessible form, such as bullion and mass-produced jewellery, with little value over its fine weight, and is thus potentially able to come back onto the gold market for the right price. Given the huge quantity of gold stored above ground compared to the annual production, the price of gold is mainly affected by changes in sentiment, which is the demand, rather than changes in annual production, which is the supply. According to the World Gold Council, annual mine production of gold over the last few years has been close to 2,500 tonnes. About 2,000 tonnes goes into jewellery or industrial dental production, and around 500 tonnes goes to retail investors and exchange-traded gold funds. Central banks and the International Monetary Fund play an important role in the gold price. Although central banks do not generally announce gold purchases in advance, some, such as Russia, have expressed interest in growing their gold reserves again as of late 2005. In early 2006, China announced that it was looking for ways to improve the returns on its official reserves. Chinese investors began pursuing investment in gold, and it has since become a top gold consumer. Gold has become more readily accessible due to the development of a range of products which investors and advisors can include in their portfolio. The diversity of gold-backed and gold-related products means that gold can be used to enhance a wider variety of individual investment strategies and risk tolerances. Investors also make use of gold's lack of correlation with other assets to diversify their portfolios and hedge against currency risk. Let's suppose you want to buy gold because you believe that the price of gold will rise. You could then buy gold ingots, store them, wait for them to go up in price, and then sell them at a profit. But you have to be sure that the gold you buy is pure. You have to find a place to store it. You have to provide the security, transport it to the vault, and other such hassles. A far better way to invest in gold would be to buy gold futures from the Commodities exchange. How do you do that? When you buy a gold futures contract, you undertake to do 3 things. 1. Buy the amount of gold specified in the contract. 2. Buy it at the price specified in the contract. 3. Buy it on the expiry of the contract. This could be after 1 month, 2 months, 3 months, or so on. Of course, if you sell the gold futures contract before it expires, then you don't have to worry about actually buying the gold. When trading in commodities, you can trade in two directions. Opening a long position refers to opening a buy commodity position to profit from a price increase. This implies that you're expecting a rise in the commodity price and will use a sell order to close your position. Opening a short position refers to opening a sell commodity position to profit from a price decrease. This means that you're anticipating the commodity price to fall and will use a buy order to close your position. We'll quote a two-way price on each market, just as you would see in the underlying market. This comprises the bid price and the offer price. The difference between these prices is known as the spread. If you think a market is set to rise, you buy at the offer higher price. If you think the market is set to fall, you sell at the bid lower price. For example, let's say we're currently quoting the gold at 1,203/1,203.70. Now, 1,203.00 is the bid price, the price at which you can sell. 1,203.70 is the offer price, the price at which you can buy. In this lesson, we've learnt what commodities and futures contracts are, the advantages of trading futures, gold as a commodity in trading futures contracts.